Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video we're going to discuss the CBOE BuyWrite Index, or BXM, and compare it to the Blue Collar Investor, or BCI system. So what exactly is the BXM? The Chicago Board Options Exchange developed this benchmark index that tracks the covered call strategy on the S&P 500 index. What they do is they buy a portfolio of the S&P 500 stocks. Then they sell 1 month slightly out of the money covered calls on this index. The calls are held until expiration Friday and they're cash settled. No activity takes place from the time the call is sold until the call expires. Then a new 1 month out of the money call is written. There have actually been some studies done on how this particular index behaves compared to the S&P 500. First of all, there was an 18-year study done by Callan Associates, and they found that there were comparable returns for the BXM compared to the S&P 500. BXM had a return of 11.77% over this 18-year period compared to the S&P 500's 11.67%. Now the main issue you need to know here is that there was less volatility with the BXM. It had a standard deviation of 9.29%, or price movement of 9.29%, versus 13.89% for the S&P 500. So there was 1/3 less volatility with BXM as compared to the S&P 500. A second study that was done in 2004 by Ibbotson Associates really had very similar results. BXM returned 12.3% over the 16-year period versus 12.2% for the S&P 500. And once again, BXM had 2/3 the volatility as did the S&P 500. Now, since I'm making this video in 2011, I decided to actually generate or create a 5-year chart of BXM versus the S&P 500. As it turns out, BXM, which is the blue line on the top towards the right part of your screen, actually substantially outperformed the S&P 500, which is the black line on the bottom, almost 3-to-1, 15% for BXM versus a 5% return on the S&P 500. But we have to remember that we had that terrible time period in 2008, the subprime crisis, where the market really crashed, and the BXM will outperform the S&P 500 by a lot more during a down market. So this chart, although interesting, is not predictive over the long run. So there are certain advantages that are pretty obvious with BXM. Since we're dealing with an ETF, an exchange traded fund, there's less time management required than dealing with several individual stocks. You also have less exposure to risk, as we saw in the 2 studies that I alluded to. There's less cash required, because in order to be properly diversified with individual stocks, you have to buy at least 100 shares of several different stocks in several different industries. Here we have a piece of 500 stocks with each share of BXM. And obviously we have the instant diversification. However, the BCI system will generate much greater returns than BXM. And here are some of the reasons why. We're not required to hold every stock in the S&P 500. We could select only the greatest performing stocks within the greatest performing industries. We can avoid earnings reports. In other words, if a stock is going to report earnings, sometimes a disappointing earnings will knock a stock way down. We always avoid earnings reports when selling covered calls on individual equities. A very important point is that in the BCI system, we utilize different strikes. We use common sense. So for example, if the market tone is negative or volatile, we'll opt for an in-the-money strike, giving us the additional downside protection that out-of-the-money strikes will not. And finally, we can initiate exit strategies. If a stock is misbehaving, it's heading in the wrong direction, we could take action that will mitigate losses on that stock, or in many cases turn losses into gains. So we have so much more flexibility with the BCI system than if we purchased BXM. So in conclusion, we know that the BXM will mirror the returns of the S&P 500 over the long haul, but with much less volatility. The BCI system can elevate those returns dramatically by implementing fundamental, technical, and common sense parameters. Which is the right strategy for you? Only you can determine that. So once again, I could be reached at Allen@thebluecollarinvestor.com, and visit my website, which has a lot of free information on this and many other topics related to covered call writing, at thebluecollarinvestor.com. Thanks for listening. Take care, everybody.